Awesome. Well, hey guys, I'm Josh Walpole, commercial director here at KW Allen. I've brought in my team of YPI, which is Young Professional Investors. We are launching early 2025. This is kind of our first in-person meet and greet networking and as well as educational event. Here during this seminar, we're not trying to sell you a product. We're not trying to sell you guys us. Really, we're wanting to provide you guys with a good foundation and resources that can help you, your clients, whoever, with their real estate investment journey. Each one of us actually has a different specialization and a different specialty that we do. Austin here is out of Flower Mound, so he's here locally with me. Then you have Austin Cassity, who is out of Oklahoma in Washington State. You have Bruce Mandel out of Vancouver, Washington. The iPhone is Michael Piehler, who is out of St. Paul, Minnesota. So we've got backgrounds in many different areas of the country, as well as many different areas of real estate. So Austin Cassidy, kick us off. Can you go ahead and read our mantra, please?
Yeah, thanks for the intro, Josh. So at YPI, we're looking to redefine the investment landscape for early stage and developing investors with a mission to empower and educate young, bold, fearless individuals to make informed decisions and maximize gains through real estate. So we're happy to have you here and look forward to chatting more.
Absolutely. Thank you for that, Austin Cassidy. So again, I'm Josh, being the commercial director. I love commercial real estate. It's kind of my investment scenario. I've dealt with everything from triple net leases for investments to self-storage, multifamily that you guys know, pretty much any commercial real estate. I've been there, done that, helped clients. So I'm more excited to talk about commercial real estate with you guys than maybe residential. That's just not my background. I would point you guys to Austin Rhodes or Austin Cassidy for those. And then Bruce Mandel has a great background. You'll hear from him here in a little bit about his background in real estate as well as investments in general. So Cassidy, go ahead and introduce yourself. Tell us about your specialty, and then we'll jump over to Rhodes, Peeler, and we'll wrap up with Bruce.
Yeah, I'm back again already. So my name is Austin Cassidy. I operate out of Washington, Oregon, and Oklahoma. I'm a fellow Keller Williams real estate agent, and I'm the director of operations and investment specialist for my team, the Tanner Realty Group. I specialize in residential investments, 1 to 4 units, as well as real estate investment strategy and plan development. So I like to walk alongside my clients, other agents, and the general public and just educate them about what real estate investing is, how to get started, and how to start building that portfolio through plan development, sitting down with them from step A all the way to step Z.
Excellent. How about you, Rhodes?
So my name's Austin. Oh, sorry. So my name's Austin Rhodes. I've been licensed for over 10 years. I'm third generation real estate, both in home sales and in building, all around the DFW area. I definitely specialize in residential sales, also in residential income, whether it be for rental properties, fix and flip. Me and my family do both of those personally. So we are pretty well versed in being able to do it for ourselves and help clients understand, what to look for and how to ideally make a profit on their investments. So, we'll kind of dive into a little bit more later and stuff. But again, one of my favorite things to really help clients with is diving deep into the numbers with investment properties and really understanding what to look for in the market, what's going to really drive demand and value, and also how to, again, hopefully make an overall profit.
Absolutely. Michael, are you available to jump in?
Yeah, I'm all good. Uh, happy to be here with everybody. My name's Michael Piehler. I'm actually from Plano, Texas, but live in Minnesota. I came up here to pursue a ice hockey dream, and then went to college out here and met my wife, and we now have a 1 year old and reside out here in the Twin Cities. I'm actually driving back from taking a look at a property we own in Rochester, Minnesota, so that's why I'm in the car right now. But my kind of involvement with YPI, what I bring to the table is a little bit different than I guess your traditional background. I started Josh is a partner with us, a private equity real estate investment firm, and we do apartment syndications. So I can get into that a little bit more later on, but essentially we pull together funds with investors and buy, own, and operate large apartment complexes. And so, yeah, I'll dive into that here in a little bit, but yeah, super happy to be here.
Excellent. So now we'll jump over to Bruce Mandel. He's the guy who keeps us all in place and showing up to meetings.
I'm not sure that I do that, but thank you for the introduction, Josh. The YPI, Young Professional Investors, is sort of a brainchild of mine in that I believe that young folks should be thinking about how to invest in things other than just stocks and bonds or just real estate. My background is 40 years plus or minus in both real estate and in the investment world. For 10 years, I was the head of private bank for Wells Fargo, Signature Line Authority at $10 million. And in the last 10, 12 years have expanded my view into the real estate world again. Worked for 25 years in the investment world as a senior vice president for a company called Fisher Investments, who you might be familiar with out of Plano. Happy to join you. Love to work with young people. And my focus is on how to help you become more successful at your investment endeavors, whatever they may be.
Excellent. So Rhodes, I'm going to jump over to you with your specialty of residential income. What are some things that you look for? What are some do's and don'ts, and any tips and tricks you have?
Yep. Yeah. So, you guys might know some of this, but I'm just going to kind of blow through it real quick. So, one, I think probably is the most important thing is really having a deep understanding of the closing costs, overall expenses that a investor is going to incur throughout the purchase of the property and throughout the life of owning the investment property. That's really going to help you, be able to save your own time from not going out and looking at a bunch of homes that aren't financially going to make sense for your clients, right? Like for example, whenever I'm working with an investor looking for a rental property, we don't go and just start looking at homes. We don't go and look at a house until I've run the numbers and it looks like there's a strong possibility that it can be financially viable, right? Especially as real estate professionals, your biggest asset is your time, right? And so protecting that is absolutely paramount. One of the main things I'll kind of start off with clients is making sure they understand the difference between a personal loan and an investment loan, right? You're going to have a much higher interest rate on an investment property because it's much higher risk for the investor, for the lender. The other thing is really understanding what areas is going to drive more demand. The same principles for home sales will translate to rental properties. In DFW, that your two main drivers of value are the proximity to the major work hubs that the property is nearby and the public schools that it feeds into. Again, the great thing about our metro is that the top public schools are viewed just as highly accredited, if not more so, than the top private schools around here. So that's one thing that you'll really find that is going to keep up that demand, keep up the appreciation for your property, is feeding into somewhere that's going to have more demand, right? I say one of the other big things that I'd think about too. I don't know if you guys have really spent a lot of time lately looking at this, but you'll notice that over the last year, rental prices, at least around here in DFW, have dipped down some from where they were 2-3 years ago, roughly. But overall, the overall sales price really hasn't dropped down enough to coincide with the drop in the rental prices. So what you're going to typically find right now is that homes that are move-in ready, fully updated, what have you, they're going to be pushing up too high of a price to where your overall monthly payment is not going to make sense versus what the rental comps show that the property is going to get. So for the most part, what you'll find right now in the market is that properties that have somewhat viability of being able to work as rental properties are more so those that are going to need a little bit of renovation, or updating in order to get the property into, and not even necessarily top dollar, but into a condition that's going to help net you the most amount of money on the rental side. So those would be probably the top things that I'd be looking for with it. Again, understanding your overall cost, the taxes that the property feeds into will be a major difference between different areas. So those are all the things that I really try to dive into ahead of time with my client before we even go and start looking at homes, right? Again, trying to protect everybody's time.
I think that's a great segue, actually, talking about the strategy, what you have to do beforehand, the steps leading up to even looking at a property or even putting in an offer on the property. So what's interesting is our friend here, Austin Cassity, actually runs through this with all of his clients. Would love to hear about your book that you have, as well as the strategies that you have with your clients and kind of the overall discussion. And then would also like you to kind of touch on what you did personally with yourself, whether, and I think you know where I'm leading you to is, did you buy a personal home or did you buy an investment property first?
Yeah. So what Austin was referring to there is definitely an essential piece of investing in real estate, but I break up investing into 6 different categories. Number one, defining your goals. So I think sitting down with that client, going through, what they're looking for, all of that is great, but they need to kind of look at what they really want. What lifestyle considerations do they need to have? What's their risk tolerance? Where do they want to be? And creating that kind of long-term 5-year, 10-year, 20-year vision of their investment journey from the start. That can always change. They can adjust it. That's actually the last step of all of this. But looking at the goals first is very imperative. And that's what I'm really passionate about, sitting down, educating them. I have a booklet that I walk them through to help navigate all of that. And then it's the research and analysis, like Austin referred to, looking at school districts, looking at taxes, looking at, just where it's going to be in general, and just figuring out where your home market is, where you actually want to invest. Then your financial preparation, that's all your loans. Are you ready to purchase these investment properties? Your property acquisition. So looking at, who do I need in my corner? Is it YPI? Is it a real estate agent? Is it a lender? Legal professionals, a property manager. So getting ready to actually acquire that property. Once you have that property, looking at the property setup and the management of that property and monitoring its performance to make sure that that money and the velocity of that money that you've put into this deal is actually working out for you, and maybe adjusting those goals or plans as you go. So, Josh, you'd mentioned kind of, should I buy a personal residence or an investment property? I work with a lot of early stage investors, even people that look at personal residences as their primary investment, or I'm investing in real estate because I'm buying a home. And although that can be true, I err on the side of caution by saying that your primary home is an investment unless you've set it up to be one. So, for instance, my personal residence, we just purchased a home here in Vancouver, Washington. We bought it actually as a strategy called a house hack. So it's using a primary residence loan for the intention to use it as a investment vehicle in the future. So we purchased this property, we're living in it, we're rehabbing it, and in a year, maybe a year and a half, we're going to move on from that property and buy the next one. So in a way, it's we call it an investment trail. I'm sure some of you are familiar with the term, but being able to get creative in the strategy based on the goals that you have to develop the portfolio that you want. If you want a smaller portfolio, or you only want to use primary residence loans, get those lower interest rates, maybe lower down payments. This is just one strategy that you can use. So by defining those goals early on, you're able to actually set yourself up for success. You're not just buying an investment property, you're not just buying a personal home. You have a plan for that asset and you can move accordingly.
I think that's great. So coming from these two guys, knowing the strategy of your clients or yourself is important to know up front. Kind of shifting gears over to the commercial space that I work in, it's the same play. We got to know the strategies how active do you want to be in your investment? Are you willing to be that person who's going to be taking those phone calls? You know, if you're in multifamily, everybody's living there. If the toilet goes out, they're not waiting till tomorrow. They're calling you that night. You're your own property management. Are you looking to do the leasing of your property, or are you going to outsource that labor to a commercial agent to help you guys out with the leasing part of that? So knowing those strategies, and then also analyzing, well, there's different sectors of commercial real estate, right? We've got office, we have retail, we have industrial, flex, multifamily, could go on and on and on. And what's really unique about each different type of commercial asset is the different types of leases that are associated with it. Sal works a lot in industrial. I'm sure he's great at modified gross leases, right? You pay your base rent and then maybe some for property taxes, but you're not on the hook for triple net rent that you might be in retail or office space. So triple nets is where you're paying your pro rata share based on your square footage of the landlord's property taxes, insurance, common area maintenance, and then you pay for your own utilities as well, right? If you're looking at multifamily, they're not helping you pay for the property taxes. They're not helping you pay for the property insurance. They'll pay for their own utilities if they're sub-metered, right? So knowing what strategy to have up front is really what's going to drive your investment, but also direct you to the right type of investment. So I think knowing your strategy, where you want to be, where you want to go is very important, especially if you're going to get into an investment and you want to grow a portfolio, maybe starting small and doing 1031s to expand your portfolio, right? Whether that's over multiple properties or just larger square footage of a single property. So that's what I've been hearing here. Bruce, would you like to tack on here, add some words of wisdom?
Thanks, Josh. It's funny you should ask. I was thinking of the old adage by a guy named Yogi Berra. Some of you folks may know who he is. He's an old-time baseball player. Yogi Berra it was famous for the saying, if you don't know where you're going, you could wind up somewhere else. So having a strategy, as Josh, Austin, and Michael talked about, is critically important. And just know that sometimes you just have to walk before you run, right? The most important piece at this juncture for many of you is to just get educated. Learn as much as you can, tap into the resources that are available, ask a lot of questions, even if you think they're dumb questions. There's no dumb questions, there's just unasked questions. And that's the way I'd approach it is have a strategy. And like Yogi Berra said, if you don't know where you're going, you could wind up somewhere else.
Exactly. I don't know if Michael's ready yet. He's going to pop back on here. He's on baby duty. So Michael, do you want to kind of talk about your investors, the strategies that you and I work on outside of YPI?
For sure. Yeah. So I would say with apartment syndications, kind of the solution that we provide in the world of real estate investing, we offer people to invest in real estate without having to do the actual day-to-day work and without having to be the one to clean the toilet and put together the business plan and find the asset and essentially all the things that these guys are talking about. If you want to benefit from owning real estate but don't have the time or maybe the knowledge or money to buy one of these large properties yourself, that's kind of where we come in. So our group is the one that is putting together the business plan, buying apartment complexes in good markets where they're poised to continue to see growth, receive cash flow, as well as renovate some units and prove that appreciation. So most of our investors are actually business owners who are highly successful. And instead of like what we're doing is not rocket science, like anybody can do this, to be honest, but their time is better spent on their own business and then passively investing with us to generate cash flow, the depreciation and tax benefits from real estate, as well as the appreciation of the assets. So that's kind of the solution that we provide here is somebody who knows and is aware of why you should invest in real estate, but they might not have the means or the time to get into it fully. And some of the reasons why I personally think investing in apartments are like a long-term good strategy is just in general, the bare necessities of, housing. Like, everybody needs a place to live. That is not going away. Something, no matter how many Bitcoins or NFTs you own, you're going to need a place to live. And where the way our economy is and the country, housing is becoming more and more expensive, harder for single family home buyers, first time buyers to break into that, you know, single family home purchase. We're kind of becoming a nation of renters. New development are normally $500,000+ houses, with land being so expensive and construction costs so high, it doesn't make sense to build a $250,000 starting home. I could get into all the actual data, but from a macro level, it's basic supply and demand, and there's not enough supply. And the most cost-effective solution is multifamily housing. So that's kind of like the quick thesis of why I think long-term investing in apartments is a great strategy. And if you want to do that, but don't necessarily want to start a new business, that's where we kind of come in and you would invest passively with us. So happy to do a follow-up call and kind of discuss kind of the nitty-gritty, but that's kind of the problem that we solve within this investing space.
Yeah. So just to kind of come back full circle to you guys here, young professional investors, YPI, number one, we're an education platform. We want to create an environment, a community of investors who can ask questions with each other, rely on each other, and be able to get good sound knowledge from someone who's been there and actually done it versus going on YouTube at 2 a.m. and listening to some guy from 20 years ago, right? So being a part of that environment, and then later down the road, we will have opportunities coming up to invest in projects that ourselves are putting in money into, as well as our work, things like that. We will have those opportunities. The nice thing about YPI comparatively to Michael and I's other company, North Lone Star Capital, North Lone Star Capital, the minimum's $100,000 is our minimum investment. Looking at YPI, we're going to be quite a bit less. We haven't determined that number yet, but if I was just going to take a shot in the dark, it might be $10,000, maybe $15,000. Now, we're not going to go and try to buy 200 units of apartments with, everybody putting in $10,000, right? But we can also start, and we've explored different functionalities of multifamily. We've looked at midterm rentals for traveling nurses and creating a good rapport with those travel nurse companies, so that, because if you're looking at travel nursing, the travel nurse company actually provides the nurse with a stipend to go live somewhere, right? Generally, that's around $2,400. Well, for $2,400, if you give me $2,400, I'm going to be there temporarily. I'm getting a studio apartment for $500 and I'm pocketing that $1,900 a month, right? So here, we're actually able to help provide a service to the travel nurse company itself to where they can sign a lease for 6, 7, 8, 9, 10 months, maybe even a year, where that it's going to be furnished. They don't have to provide that stipend to the nurse, but everything's already set up for them. So it benefits the nurse who goes there. They don't have to get any furniture or anything they don't want to bring. It'll already be furnished, set up for them, power, internet, everything's good to go. And then it helps the company save money really on the back end as well, right? So we will have opportunities like that in the future. But now I'd like to open up the floor. We're completely open to answering any questions, any of us on the panel. Feel free to ask us anything from residential, commercial, Bruce's background in stocks and bonds, what made him flip a switch to real estate. Anything's available to you guys. Hello? Hello? Okay.
Hey, Josh.
Yeah.
Josh, Bruce here. So, as you're looking at the markets today in the DFW area, because we got a lot of people that are there, where are you seeing the most competition in the marketplace today, and what's causing that competition to be heated up?
Sure. I think to reiterate, where is the highest competition within the DFW Metroplex? What asset class and why is it? I would say it's going to be retail in your primary and secondary markets. So primary being Dallas proper, Fort Worth proper, secondary being the suburbs, kind of like where we all live. That's because retail right now has beat out inflation all the way through. As soon as we could go back to work after COVID, retail has beat out inflation has been a great return for landlords and investors. And so retail has become extremely competitive as far as leasing rates go, base rent goes. Triple nets, they net to net zero, so you don't really have much of a leeway there or negotiating power. But on the base rents itself, retail has outpaced inflation, so it's the most competitive. Now, looking at the opposite end of the spectrum, I'm sure you guys have seen every office building around here that's completely empty, and for some reason, we're still building more, right? I don't know. I'm not a developer. So with the office buildings, we have seen them loosen up a little bit more and more and more as far as lease rates go. For example, the building we're in right now, next door, started at $32 a square foot. They're now down to $25 a square foot plus nets. So lots of landlords have changed from let me get the highest dollar to let me have more occupancy in the office space. So they're willing to cut those base rent costs, which does affect their bottom line. Hopefully those landlords own it free and clear, because then the base rents go in their pocket and not towards their note. And then the triple nets help them cover the rest of their expenses. We had one question from the audience here, from Sandra. I don't know. Here, give you this.
Okay, so I've got a couple of clients wanting to do short-term rentals because they can't make a profit in buying a single family. So their challenge, of course, is where can they buy one that they're not going to be penalized later on? Obviously no HOA, but they don't want to be in Dallas now because of all that. And then the model of the kind of co-living, like you're talking about, the nurses and also pad split and those kind of things. Like, are you seeing that being more lucrative for your investors?
We'll get both Austin's take on this one. We'll start with Rhodes.
Yeah, so it's actually pretty interesting. I think with short-term rentals, it's I don't think there's a clear-cut answer, to be quite honest with you. There's a lot there has been, and I believe there's going to be a lot more change in the rules and regulations for it. Funny enough, literally this morning, when I live in Carrollton in a non-HOA neighborhood, right? But I got a text from one of my neighbors that they're on Thursday going to have a meeting at the city council about the VRBO properties in our neighborhood. Honestly, I never felt like they really caused too much of an issue or anything like that. And honestly, my neighborhood in our area was one that we were talking about as a group, YPI, of possibly investing in for this purpose, right? And so if you would ask me yesterday, I would have probably been recommending somewhere around that area. In general, you'll find that the two northern counties have a little bit lower taxes than Dallas and Tarrant County, right? So that does help for your overall profitability. But now, as far as, changing laws, regulations, all that kind of stuff, I definitely couldn't give a 100% confident answer on that. I know that we've seen lots of other cities and towns here in the metro that have changed their policies, right? Dallas isn't doing it. Frisco's really cracked down a lot, right? So unfortunately, I think that it's going to be a trend throughout the Metroplex, right? Especially when you see so many investors that basically are allowing the tenants that are coming in are, creating a nuisance for neighbors and whatnot, right? Trashing the place, blah, blah, blah. So unfortunately, I think it's something where if I was going to do that, I'd be maybe more so looking outside of city limits, or in ETJs where there's a little less city or government, regulation for it. But being 110% honest, I still don't have full confidence that, they'll be able to continue to use it indefinitely, unfortunately.
Yeah, I think that's a great point, Austin. Right before I get to you, Austin Cassity, one thing as well to think about, I know that was a little bit rainy of an answer for you, but on the brighter side, being able to find these new developments that are going on out there, the Jimmy Buffett casino, if you will, up by Red River. Not everybody's going to want to pay those hotel bills. So maybe you want to find a short-term rental that's closer to that facility. And that's a bit more of a rural tertiary market. And so they'll be a little bit looser. The other interesting thing, Chris and I found this out a few weeks ago. If you have a great relationship with a SBA lender, a small business association lender, you can actually use SBA financing for short-term rentals. As long as the rentals are 30 days or less, you can use SBA financing, which is only 10% down, but it is a higher interest rate than what you would get at your 20% down for your investment residential loans. There is no PMI, no, but rates are about a point above Wall Street Prime. Right now, Wall Street Prime's at 7.75%. Real quick, Chris, over to you, Austin Cassity. Did you have any other thoughts on short-term rentals?
Yeah, I think like what Austin said, there's no real clear-cut answer for that. But it does, since they're your clients, it does go back down to sitting with them and defining their goals and what they're trying to do with the property. You'd mentioned, oh, they may be interested in like a midterm solution with the nursing, all of that. And while that might be a solution as well, it just really defines, or it really depends on what they define as important to them. There's generally three ways. This is one of Bruce's acronyms to make return on residential or even real estate investments in general, and it's appreciation, cash flow, and taxes. So why are they buying this property? Are they looking for the cash flows? Is that what is like attracting them to short-term rentals, or are they looking for other avenues? Are they looking for the appreciation? Then maybe looking in the primary markets, but they can't expect a ton of cash flow from those. Interest rates being elevated have made it difficult to find these. And then the HOAs are cracking down. Cities, even in our area, you're required to have permits to do short-term rentals. So it's just doing a lot of due diligence up front to make sure that your investment is safe there and looking at the best locations. What's drawing people to your short-term rental? What's the surrounding environment and market looking like? And it's just going to take a little extra research. But if they're willing to look at other investment avenues, it might be time just to see, what are your goals? What are you trying to do with real estate? Is it a short-term rental, or is it just that you're trying to find cash flow?
Yeah, and just so I'm not so doom and gloom about it, one thing that I would think about and talk to your clients about if they're wanting to do short-term rental properties is trying to be located as close as you can to different entertainment districts, lakes, right? Things where it's going to keep, a lot of interest for, different events and whatnot. Also around the lakes, you'll find that for the most part, there's a lot less regulation. So it's much easier for you to be able to do short-term rentals. So that would be another area that I'd probably look at too for your clients.
Yeah,
To
one last.
echo what both Austins have said, you got to figure out what their strategies are. But the other thing you want to make sure that your clients understand is what market are you trying to address with your short-term rental? Think about what the economic striation is. So, as an example, back to the point, you're thinking about lakes. You think about somebody like, you could think about like Granbury, Lake Granbury, which isn't very far away. It has both, cheap, inexpensive, and very expensive places. Who's my market, and how am I going to do that? And also, at some point, you got to figure out who's going to pay for this, right? And how do I want to do that? And oh, by the way, how am I going to service my resource? But yeah, both Austins are correct. We have some, and so as a result, I would say to you, think about who your market is, and then go from there.
Yeah, and one last point on that. As you mentioned, short-term rentals are being pushed out of the market, being outlawed. But one thing I wanted to circle back to was that you were suggesting, home prices has continued to rise, even though rental rates may not have, right? A last-ditch effort is gaining that equity that you've built in that home. So if that short-term rental is no longer allowed in that community, you did just grow your equity within that home to be able to sell it to first-time home buyer, secondary homeowner, someone else who would like to live in that community. So you do have that last-ditch effort to pull the lever. Chris, I believe you had a question as well. Use the mic.
Going on using SBA financing for a short-term rental, I want to just make sure and clarify that just like a commercially zoned property, you could also use that SBA loan for construction and acquisition.
That is true. So in SBA financing, there is a loan product in which they allow you to put down 10% of the project. So you put down 10% of the land acquisition, 10% of the construction costs. If you're going to do any working capital, which you really wouldn't for short-term rental, you can put that into one loan. And essentially what happens is they build a umbrella loan on top of the bridge loan. So your bridge loan is supposed to be interest only, 1 to 3 years during renovations or construction. Well, they actually build an umbrella loan on top of that to pay off that bridge loan. So you don't start paying until construction is completed and you're starting to lease out that space. So that's very helpful. Getting an SBA lender to do that for a short-term rental is pretty tough. You may want to increase your unit count. They're not going to do it for just a 1-unit single-family home, but maybe if you were building 3 4-plexes or something like that, they could definitely, that's an easier bite to chew than just one single-family property. Were there any other questions out there?
So I typically work on the commercial side, but I'm curious on the single family. When you look at the investments for single family that you're working on with your clients, we typically look at the metrics, right, in order to determine whether or not it's a good, viable investment or not. I've typically noticed when my wife deals with investors on the residential side, they don't really necessarily look at the metrics. They just want to get into an investment. So are you helping them? If it's a long-term investment, right? Are you showing them metrics, or how are you helping your clients that are investors realize that this is a good investment or not without, because you always have to find out what your exit strategy is, right? In the Airbnb business, the exit strategy is you do a longer term hold and then you sell the property and then you get the equity, right? So when you work with your clients, again, on single family, I'm just curious how you and the Austin Squared, how you guys decide, how to provide the good guidance on the residential clients that are looking to invest in that area.
Yeah, absolutely. If it's okay with you, Cassity, I'll kind of answer first and you can tag on if that works. So what I do in those scenarios when I'm helping residential income investors, right? I might be a little bit different, right? I am very focused on the numbers, right? Because I mean that's essentially the whole, unless they have an ulterior motive with it, right? That's really their whole goal, right? Is to make money on it or at least break even, at the very least. So what I'm doing before like I was saying, before we even go and look at homes, is I'm going through and running an estimated net sheet of what it's going to cost for overall their monthly payment and their closing costs, right? And then give them estimates on if there's any repairs, renovations that are needed for the property, of course, to factor in. And then running the rental comps to see what realistically do we think we could get for a rental or for a lease amount for the property. And then comparing what the estimated monthly payment is versus that overall potential potential rental income. And so that's what I'm really doing to get a good idea of even if it's feasible or not, right? Because even in some of the most desirable areas, you're losing $300-$400 a month, best case scenario, right? And so if you guys don't have some kind of mortgage closing cost calculator that you guys use, I definitely highly recommend getting one. There's a lot of places you can get it for free, or there's lots of title companies that provide that as a free service as well. And I use that absolutely all the time, even outside of residential income investment properties as well, because I think the most important thing as agents is providing clarity and transparency to our clients, right? Because ideally you help them make a good investment, they make more money, and they go out and buy more and more and more investment properties and refer you to more people, right? If you go out just to make the transactional sale and it turns out to not be a good investment because you didn't do your proper due diligence as an agent up front, A, shame on you, and B, you're not going to get the business again or any referrals, right? And so, for me, doing the right thing up front for the clients really helps to pay dividends going forward. For example, for the last 15 years, my family's company, we've been the number one team here in the metro and have over 50% of our business come from repeat or referral clients, right? So we are very, very hyper focused on doing what's right by them. I even say that I'm a terrible salesman because I talk people way more out of deals than I ever would into them, right? But that care for your clients is what's going to help double, triple, quadruple your business long term, right? And so again, going back to your question, I go through with the net sheets and show them both the sales and rental comps to show the probability of them being able to make a profit on it versus what their costs will be, if that makes sense.
But you're still not running the numbers over a 5-year, 10-year term like you would in commercial or
Not necessarily, but what you can roughly factor is that taking COVID aside, for the previous 20 years here in DFW, you've had a rough average annual appreciation rate of about 3%, roughly kind of what's going on now. So you can also kind of factor that in a little bit as far as what a client can roughly expect their property to appreciate. And then, of course, how that plays into effect of their monthly payments and everything like that. So it's a little bit lesser so on running through the numbers in the 5, 10, whatever year plan with your clients, but it's definitely still a factor, right? Because right now, I mean, it is extremely hard to even break even with long-term rental properties. And so a lot of investors now are pretty much okay with just breaking even. Obviously getting over, but if you can break even, then the mindset is okay, here in 2-3 years when it appreciates and everything, and also ideally with the appreciation, the rental prices increase. And so then the long term, you're going to start making more and more with it. So that's kind of usually also the threshold of what investors for residential income are looking for right now. Cassidy, do you have anything to add to that, bud?
Yeah, I'll add on to that a little bit. I think you're correct. It's so important to at least bring the data to the table. So it helps me sleep at night. At the end of the day, it's their decision, it's their investment, and we can advise as much as we can. But I do the same thing. I'll sit down with the investor. I will, develop their plans, see what kind of houses we're going to go look at, and we could go out and they may end up choosing the one that on paper looks like maybe not the best investment, but it's their decision, and I've provided the data. I've provided maybe that 5-year projection, not in depth, but just as a service to them to say this is average appreciation. This is what rents have typically done in our area for this location, and just provide them with all the data and allowing them to make that decision. Because at the end of the day, we're consulting with them. We're not making the decision for them. We're not placing their money. We're helping them grow their portfolio and grow essentially their real estate life, and allowing them to take those steps. And in residential, we do see a lot more emotional decisions than data and number decisions, and just comes with the territory. But all you can do is advise them and help them through the process.
Yeah, so I think both Austins kind of touched on cash flow of the asset, especially is a huge component looking at residential investment properties. One component that is a major component but less talked about is the tax incentives that come in to play as being an investor. I'd like to pitch this over to Michael Piehler to talk about kind of some tax incentives. I know we have some over at North Lone Star Capital. Kind of how does that transfer into your regular everyday investor?
Yeah, from the single family side, I guess I'm not too sure, but from what we're buying on the multifamily side of things, you can typically expect from the depreciation and the cost segregation study that we do on our assets and
accelerating the depreciation. Typically, the cash flow distributions that you receive during the hold period of the life of the investment would be offset from the depreciation. So typically, if you let's say you receive 7% or 8% return during the year, that should be more than offset by the depreciation. That's pretty standard. On top of that, I would say right now, where the tax law is, you would expect like between 35 to 45% um, of a loss, a paper loss in year one. So let's say you invested $100,000, your K1, and we might be getting into the weeds here, so I'll keep it real brief. But essentially, you would expect a $35 to $45,000 paper loss show up on your K1, which you can apply passive losses to passive gains. So if you realized and had capital gains tax from a sale of an investment property, as long as you make the investment into our syndication within that same calendar year, you could theoretically offset the capital gains from the depreciation of our investment. I'm not a CPA, consult your CPA, but that is definitely a huge benefit to investing in real estate is the tax benefits. And you want to make sure your CPA, if this is right, you want to take, they're well versed, because there's a whole lot of strategies that you can take on the real estate from a real estate perspective to offset and mitigate your tax liability.
Yeah, Josh, let me echo on that a little bit. After 40 years in the market, one of the things being both in real estate as well as liquid investments vis-a-vis the stock market, the becoming educated at the tax pieces for your investors is critically important. You will uncover things that they have heretofore not thought about. And as you educate them further on the tax capabilities and the tax advantages of real estate, many of them, the lights will go on and they will begin to listen more acutely to what you have to say. So when you start out in perhaps a little bit of a push-pull adversarial role, as you try to go through the numbers with them, as you educate them on the taxes, they will become more and more likely to follow your lead and your information. The greatest thing about real estate, as many of you know, because people make a lot of money, the best piece about real estate is the leverage capability of the real estate itself. Most of the great wealth in this country was made through real estate because of the leverage. And if you think about it, over long periods of time, if you buy a piece of real estate and it returns at 15% a year, you doubled your money in 5 years, right? The only way you can really make up big numbers is if you calculate in the leverage therein into the whole piece. That's why working in a syndication for people who are, making money but are lazy is a great thing. For many, they have to get started doing individual real estate. So finding the right locale with the right numbers and the right tax pieces is really helpful for them. Because if you can buy or sell something and not have to pay taxes, significant taxes on it at the time of transaction, it's a huge springboard forward towards increasing your wealth. So back to my original point is get very educated on the tax pieces of real estate, because back to as Austin talked about it, appreciation, cash flow, and taxes. The hidden wealth benefit is in the tax application they're in. And oh, by the way, the government's working with you because they write the tax laws to make real estate investing a very, very profitable endeavor.
We had one question here from the crowd.
Yeah, going back to single family cost segregation, which is typically seen in commercials. Do you guys use that cost segregation on the residential single family aspect or not?
The answer is it's absolutely can be used if it's an investment property.
Yeah. If it's investment, you can use it. If it's an investment property, whether that's single family rental, short-term, mid-term, long-term, you can use cost segregation analysis as long as it is not a homestead property.
And does it?
So cost segregation analysis You essentially hire a cost segregation company. Sometimes it's a civil engineer. They come in and they depreciate what I call the mud and the sticks of the property. So they're not going to depreciate the foundation, the brick, the mortar, but they could depreciate the light fixtures, the light switches, the doors, the doorknobs, door hinges, everything on the interior of the property, provide you with that value, and that's your depreciation value. Right now in 2024, you're able to take 60% of that value going into 2025, unless Trump re-ups it back up to 100%, which I think he should. It's going to drop down to 40%, but it's a paper loss. So you're actually not losing any money. You're just basically writing off what's within the property.
So does doing the cost segregation actually make sense financially in terms of getting the study done at that low of a real estate investment level, I guess you could say, right? Versus the large multifamily.
I think as long as the price of the study itself is less than what you're going to save, it's worth it, right? It's kind of like going to the grocery store. You got buy two avocados, get the third free, right? Well, I'm going to have guacamole. I might as well just buy two avocados and get that third one free, right? Even though it's 70 cents more, I'm getting another one. So as long as it balances out there on the initial value, at least for me personally, it's worth it. Now you can talk to your cost segregation analysis company and say, hey, what are your thoughts? And hopefully you have a great rapport with them, or you have an honest guy who's just going to tell you, is that worth it or is it not? And do that process going forward. Yeah.
Yeah, because also, with residential income, I mean, with any investment property, but especially residential income, is that overall your margins are really small. Like I was saying earlier, I mean, you're right now like pretty much lucky if you break even. So, the other hard thing is that I didn't really touch on before is, getting a good understanding of the condition of the house, right? Because, for example, if you have to replace an HVAC, that'll wipe out all your profits for a year or two. You know what I mean? And so, like Josh was saying, getting an understanding of what that actual cost to do the cost segregation study would be, that's really where I would start for it. Because I think with any investment, you got to look at the overall big picture, right? So that's really how I would make that decision based off of what I do for a single family. I mean, it might make more sense if you have a big portfolio, right? But just for a single one, that's when I would just really kind of evaluate the cost for it.
For appreciation. So somebody gets to pick this. Do you want appreciation or do you want cash flow? Multifamily, you can get more cash flow, but less appreciation, and the flip side on a single family? Or do you have people that are, because it seems like everybody I get single family, and then they freak out when they aren't they are not profitable at all. And, I'm telling them, like, offset your risk by doing a home warranty, especially if stuff's old or something like that, because you're right. I mean, an AC, they're toast. They're coming out of pocket. Yes, they're appreciating, and depending on where they are, they could appreciate a lot more than 3%. But I mean, I think that's where I'm struggling with my clients. It's like, okay, yes, you don't have a cap on your taxes, or kind of we do for a few years, but it's like there's that unknown out there for them, and all your eggs are in one basket. It's like but that's what they're comfortable with. That's where, they get single family. Some of my people, I'm trying to get them to convert their residence into an investment and buy a new residence. And like he was talking about,
right?
Like kind of homesteading it and having it for live 2 years, have 5 years, sell it in 5 years, and do that. But
yeah, I think the appreciation component will come irregardless of which asset, whether it's multifamily or single family. It's most likely going to appreciate. Having cash flow is nice, right? And so even looking at Michael and I's syndication company, the largest payout that our investors are going to see is when we sell the property. I mean, yes, there will be cash flow. Could be, on our latest one, we've got 6%, right, for our bottom tier. So you can get that 6% year on year for 5 years, but you're really going to make 55% of a return at the sale. Right now, that's not guaranteed. Read the fine print, everything else, right? But the appreciation's more than likely going to be there. And so if you can cash flow, great. If not, at the end of the day, your biggest payoff is going to be the appreciation factor, right? And there's other different ways that you can work. I know a guy who's out of Las Colinas. The way he's made his wealth was wraparound mortgages. He would buy a house, lease it. That person may or may not be able to get a loan from a typical lender. So he would do a wraparound mortgage, and if they default, it's basically seller financing goes back to him. He'll restart the term with different interest rates. And then rather than being on year 5 into a 30-year AM, you're back at year 0 on a 30-year AM. So there's different ways to grow your wealth and different ways to grow your cash flow for it. But initially, with me and my clients, the conversation I have is the biggest benefit is going to be the appreciation. So getting into the door, getting your investment rolling, and then pushing it to where you can do refis on lower interest rates. You can add a different amenity or something like that to increase the rental value of the property to gain that cash flow afterwards is definitely possible, but getting into the investment is really the hardest step.
I'd add
Go
something
ahead.
on that real fast. I missed maybe the first part of that question, but what I heard is just looking at the appreciation cash flow taxes, just trying to, if the cash flow is not there, is the appreciation really enough to make a sound investment? And I would argue, I mean, the three of those, it's a starting point. And we're talking as if we're always buying properties at the top of market value. We just may need to get a little more creative in the acquisition of that property of, can I find a home that needs a little bit of work that I can build an equity buffer in there for if that cash flow isn't great, or if the appreciation is as quick as I wanted or projected, that I still have equity in that home. That's another way to make some great income. That's what we did with our place. Put some sweat equity into the place and build that buffer and look for different property acquisition styles to be able to kind of force appreciation into that property. Are there certain features you can do? Can you build a shop with an ADU on the property? That's really popular up here. Can we force density on the property? So it's not just looking at the singular asset at the top of market. It's how can I find those, needle in a haystack? And by having the plan and knowing specifically what you're looking for, when that opportunity comes, you can jump on it really fast.
Awesome.
I
Are
would
there
add,
any? Sorry, go ahead, Bruce.
no, it's okay. From a historical standpoint, after 40 some years in this business, if people are really concerned about cash flow and they want to buy real estate, they should be buying REITs on the public market. And the reason you buy the REIT is because you have the real estate, but it has cash flow. And you probably don't have enough money to really buy a house. And if something goes awry with that investment, you're up a creek without a paddle and not enough money to fix it. If you have enough money to buy a house, then you ought to be thinking about, how do I do that? And what's my next step? What's my next leverage step? Because the biggest leverage step is for somebody who's a busy professional, unless they want to be in the real estate business like y'all are, they should probably be looking at how to invest passively and get the benefits, but have somebody else do the work, right? And that's where, some type of syndication or buying multifamily vis-a-vis fourplex and above, right? That's bigger leverage than a single home. So if somebody's looking at, pick a number, 20 to 60 to $100,000, and they're not an accredited investor, they might look at, in the short term, just buying a REIT and being patient and let things work. I know that's not what you want to hear as a real estate agent, but long term, if you're giving your clients really good advice, they're going to come to you and they're going to say, well, that money that I put in the REIT that was 75 is now 150 or whatever it is. Let's go buy a fourplex, and off you go, right? So it's one of the things you don't want to do is be the dog with the bone in your mouth, looking down at the river and saying, oh, look, there's another bone opening in your mouth, dropping in the river, and seeing it go. give them good advice. That's what we're trying to do with this group. Give people really good advice, and it'll return to you tenfold.
Absolutely. Are there any last questions? Nope.
What about self-directed IRAs?
Self-directed IRAs. Bruce, you want to jump on that one?
Sure. Okay. So, just FYI, my wife and I have, large six-figure in self-directed IRA in real estate. Great place to invest. The downside of that, quite frankly, is you cannot take advantage of any of the depreciation, which is a huge piece of the real estate. Not a bit, not necessarily bad, but that's an issue along the way. You also have to have a custodian that allows for that type of activity, and they are available, but they're not always really great at that work. So, be careful about that. Personally, we have some money in that thing, and I like it. But that would not be real estate. Wouldn't be my first place that I'd put my self-directed IRA, because I like having all the benefits, the tax benefits. And if you have great cash flow, you really can't use it either. So you're really, if you're going to invest for appreciation in your self-directed IRA and real estate, great place. But got to remember, if you put money in a self-directed IRA and for in a house, you personally can't do any of the work at all on it. It has to all be hired out. Otherwise, you can get yourself in the crosshairs with the IRS.
Absolutely. Well, guys, that kind of concludes our first session here. We'll have more as 2025 comes. We'll have in-person meetups just like this one, virtual ones where you can join us on the Zoom calls. We write newsletters, so we'll be publishing those as well. If you guys have any questions for any individual here on the panel, I can connect you with them, give you their contact information, everything like that. But really want to appreciate and thank you guys for coming out to our first one here. Again, I'm Josh. You got Austin Rhodes, Austin Cassity, Bruce Mandel, and Michael Piehler. We're here to help you guys and support you guys. So if there's anything that we can do, feel free to